Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Michael Clanin, who's a certified financial fiduciary with Safe Money Solutions, and we'll be talking about business and estate planning structures. Michael, welcome back to the program.
Well, Mike, thanks for having me back again.
You are welcome. I remember before we had a really warm, flowing conversation. You just make things very, very clear. And it's really powerful to be able to have a message that's delivered where people get it and go, ooh, I need to learn a little bit more about that. So I'm excited to learn about this because I would venture to say this could be a 3-day weekend seminar and still not be, scratching the surface. So I know we're going to talk high level, but talk a little bit about some of the main pain points or concerns that business owners face or even high net worth clients regarding the business and estate planning type structures that you're working with them on.
Yeah, so I have clients, and a lot of my clients are business owners or these high net worth clients, and you probably know what their biggest pain point is, Mike. Along with everybody else, it's
taxes.
The taxes.
Yep.
Right? I didn't even get it out before you started.
Yep, I knew it.
So that is a big pain point that not only are they facing this year, but every year that's getting bigger and bigger and bigger as their business is growing, and even for as long as went up to the point when they want to sell that business, right? They're going to be hit with large capital gains, right? So
yeah,
the biggest thing is where do we stop, or what are solutions that can stop us from donating more to the IRS than we need to?
That is a really well phrased use of terms, donating to the IRS, because on one hand, I want to donate money to worthy causes, but the IRS ain't one of them.
Right. And my other term that I've used in the last one, that's a new one I started using, but it's how do we divorce the IRS as much as possible, ethically, legally, and morally?
Yeah.
Pay our fair share and no more.
Yeah, I think that's a thing that a lot of times people, hear when you have these conversations like, oh, well, we need to skirt the IRS and pay no taxes and go offshore. Nope. We want to pay as much taxes as we're legally obligated to. But if there's a deduction on the table, I want to know about it. If it's legal, moral, and ethical, I want to know about it.
Yeah, who wouldn't, right? And these things that we'll be talking about are not new. It's just new to people because they haven't worked with professionals who even have access to what I have access to. I'm one of 15 people, not only in the United States of America that can offer this, but in the entire world, because this also works worldwide.
Wow.
So So when I'm privileged to be able to offer this to my clients, because they're professionals, whether it's CPAs, attorneys, they don't even know about these things and they've never been trained about them. And, again, I want to put it out here, right? I'm not an attorney. I'm not a tax professional. And that I'm just a glorified educator, using different vehicles to accomplish the things that my clients are trying to accomplish.
And that's a great point, because if you tried to be all things to all people and be the expert in everything, something's going to implode. So you work within the confines of a team, whether it's your experts in legal and tax or the client's team. Maybe they go, oh, I've got a guy. Good. Right. Let's bring him on board and bring him up to speed, because we just want to make sure all the pieces are working together. When I hear what we've been talking about here, pain points, taxes, got it. It sounds congruent to say business owners, because there's always the things you hear about, like, oh, if you're a business owner, you can write off for access. But a higher net worth client that might not be a business owner, sometimes people go, oh, but some of these things won't work for me because I don't own a business. Are there still some opportunities if you are a W-2 corporate employee, but more high net worth?
Yeah, I mean, I'll tell you what, these business structures, business and estate planning structures. So the estate planning, of course, is on the personal side. The W-2 is not going to help, right?
Yeah.
Because you're getting paid personally, through your Social Security number. Anything else, whether a business, if they're getting a K-1 distribution, capital gains, royalties, dividends, interest. Anything like that, that's where it's going to come into play. And I think I mentioned on the last episode, these business and estate planning structures can save clients upwards of 80% or more in what they're paying in taxes this last tax year. What'd you
Wow.
just get done writing that check to, right? Check to IRS, right? That donation. What if there was a way that you could have kept a majority of that, if not close to all of that, in your pocket, in your business, in your possession, to create even more wealth?
Yeah, that's huge. So you mentioned about how proprietary this is, and how you're one of a very few in the country or the world. Why would that be? In other words, is this like literally part of a I don't know what you call it, but a system or a set of processes? Because when you hear the word, legal or estate planning, you can go Google a lot of stuff on that. But you're saying yours is so much high level and deeper that not everyone out there, even if you are an estate planning attorney, can offer this because of the way that you guys have structured it, right?
Right. So yes, it is. Yes. So you know what? I was very fortunate, right? I was at the right place at the right time. And guess what? Somebody thought of me, meaning a colleague of mine thought of me that I would benefit from this personally, right? So I was a consumer of this before I started being able to offer it.
Neat.
And that's just because that relationship that I had with that person was able to connect me to the law firm, the CPAs on this side, where I'm a distributor, I guess is the easiest way to say it.
Like you got licensed to provide this high level proprietary process.
I'm not licensed. No, I'm not licensed.
Oh.
It's just a service. It's a system. It's a system. It's an ecosystem. As long as we work inside this ecosystem, and we'll talk about the benefits of that. But as long as you work inside this system, okay, you're going to not only save potentially a lot of taxes or defer taxes indefinitely, but you're also going to have asset protection and everything from all outside forces. And we'll get into that, I'm sure.
Yeah, I definitely want to get into that. So it makes me think of something too, and I know we briefly touched on it, but legal, moral, ethical. I think when people hear some of these things like structures or legal or trust or whatever the case is, it's like offshore and shady. And I saw a movie about that. Yep. So let's kind of knock that 800-pound gorilla off. Talk a little bit about the ethicalness of this, and is it proven, and does the IRS approve of it, and all that.
Yeah, so this follows all tax law, IRS code. In fact, Mike, this is not, like I said, this is not a new structure. This was actually created back in 1952 by an attorney who had lots of friends, because he lived in Texas, lots of friends in the gas and oil industry, right? They were getting hit with royalty taxes. Right. And once it's all about repositioning how you are set up as a business. Right. And the money mechanics of moving money around. It's not about where it starts. It's where it ends up is going to determine who's getting taxed and at what level and all of that. OK. So as far as this, going back to this, yes, it was the first ever copyrighted trust structure. Okay. Legal structure. So of course, what does that do? It triggers IRS, right? Yeah. They came in and audited these structures. right? 2 weeks, the gentleman came back from the IRS, and not only did he say, "Does this follow all tax codes?" He actually purchased it himself because he saw the value.
Wow.
Now, it was copyrighted in 1999. So it had been around since 1952, but it hadn't been copyrighted till 1999. Again, like I said, it was the first ever copyrighted trust. So, here's 70 years later, right? And that. So, yeah, I mean, it has a history. It has precedence. It's never, it's been audited. There's never been findings. It's all kosher. So when they know the name of this trust, being the IRS, okay, they don't push it any farther because they know as long as we're working with the right professionals, that's keeping it in compliance, right? Yeah. The attorneys, the CPAs, enrolled agents that are doing the tax return, because these still do tax returns. It's a 1041 tax return. However, this is not necessarily a taxable entity as long as we work inside the structure. I mean, we keep the money inside, working inside the structure. We're not pulling it out. Okay.
Well, and again, I want to be really careful and clear. Let's dive into the details. Yep. Nope, because I don't even want to get into the details, because we just want to know super high level. Yep. But you've said the word trust before, and I think that sometimes people go, "Oh, trust. I've heard this, or I don't need." What sets this type of trust structure apart from others?
Yeah, so let's talk about that, because here's the thing. I tell people every day, all trusts are not created equal. Okay. Mm-hmm. Here's the thing. All attorneys are educated under statutory law and legislative law. Okay. This is the only trust structures that are under contract law. So which means this trust is actually a spendthrift trust. But what that means is this does not owe its existence to any act of legislature. Okay. And because it's a contract, we have the right to contract. And in American law, government cannot impose a tax on a right to contract. And that's actually under U.S. Constitution, Article 1, Section 10. Okay. But here's the thing. The biggest thing is, because it's a spendthrift trust, it's not a creature of legislature. So therefore, it is not subjected to all those strangling legislative controls, rules, and regulations that are applicable to corporations, right? C Corps, S Corp, LLCs, partnerships, or any other legislative entities.
So it's almost like when like you said, when the IRS sees this, or when they come in, when this comes in, they see this type of setup structure, and they know, oh, wait a minute, let's flip to page 4,312 in the code. We now need to follow these rules because it's there, it's allowed. It's just a different type of a structure.
Yeah, I mean, so really, the governing law it's a private it's under private contract law. Okay, so that the contract is between the person who sets it up and the one that's putting assets into it. Mm-hmm. Okay, versus statutory law. You guys, most trusts out here have to pay monies out and have to pay taxes, and the taxes are at the highest tax rates. Mm-hmm. Okay, there are different provisions within this structure that gives the person, first of all, when individuals move things into those others, they actually lose control of those assets. Okay. But the other side of it is, because it's still tied to their social security number, those assets can be pulled back out. So even if somebody has let's just say, again, I'm not an attorney. Okay. But let's just say somebody even has a revocable trust. They can still, the courts and judges can still see inside of those. And if there's a judgment, they can force that person to pull those assets out. Why? Because it's tied to them personally. And then that's how businesses and livelihoods and legacies get wiped out. Okay. Because
and people think that, set up a trust and you'll protect everything and be safe and you can never be sued and my business is protected. And that might not always be the case. It depends on how it's set up.
Well, right. I mean, let's just talk about, entities that are registered at the state level, right? This is what all business owners are doing, right? They have LLCs, S Corp, C Corp, or partnerships, or any of the other things, right? They're subjected to the state legislature, okay? But when, because of that, those entities can a person still be sued, right? Right. Anything that's tied to your social security number, meaning people think they have to own things personally. And what this trust structure is doing is saying, no, you do not want to own it personally. Because when you hold things personally, they're exposed. They're up for grabs in lawsuits, divorces, judgments, all that. Okay, creditors. Well,
so just because you put it under the umbrella of a specific type of trust, it still could be pierced because you think you're fine, but in reality, there's still a dotted line connection.
Right. So whether it's in a trust or not, I'm even just saying if they hold it individually outside the trust, right? And I'm not saying all trusts are not good, right? I'm not saying that. There's places for them. But a lot of those are specific situations, like land trust. Revocable trust is the most common. That just avoids probate. There's no tax advantage. There's no asset protection. There's Medicaid trust to keep people from spending all their assets, so they can, keep some for their spouse. But the thing is, anything that's registered at the state level as an entity, a business, can a business get sued? Of course, right?
Yeah.
But here's what I hear every day. Well, I have an entity. It protects me personally. No, it doesn't. Because they're going to go after your business. But once they uncover what you own personally, they can go after that too. That's why I said businesses and your personal wealth can be wiped out overnight. Okay.
Wow.
Where I'm trying to put a client in a position where nobody can get to anything. Why? Because this structure actually has its own EIN number, but because of the way it's under contract, it acts as an individual. It has all the rights of an individual. So like if I want to buy something, a property, a business, right? A person can do that and a business can do it. Well, so can't this entity. Right. But if I ever got sued, if that business ever got sued, guess what? And it's owned by this structure. Even if they win, they're not getting anything.
Wow.
Nothing. The only way is if it's being set up and there's fraud that is intentional to be created, like they're creating the structure to commit fraud, right?
Yeah.
Avoid something. It could be avoid a lawsuit. A divorce is already filed, right?
Yeah.
I mean, anything that you're trying to hide things. We're not trying to hide assets or, we can avoid everything. It's not illegal to avoid as long as you're taking the tax code and the law into consideration, right? And you're following by all those, rules, right?
Yeah. Follow the rules. Makes sense.
Follow the rules.
It's kind of like what you said previously that I thought was so powerful. Own nothing, but control everything. So talk a little bit about how that works as we wrap up this.
Yeah. So this was coined by John D. Rockefeller. And people have heard this, but they really don't understand it. Okay. In my opinion, what he is saying, just kind of like what I mentioned, people think they have to own things personally, meaning they are egotistic, right? We think we have to own things. Okay. But what John D. Rockefeller is saying is you do not want to own things personally tied to your social security number or EIN numbers. Okay. Because it's all at risk. So how do we create something that alleviates all that? So first of all, not to get in the details, But when somebody uses their social security number to create the EIN number for like even a legal structure, they are a grantor. Okay. It's tied to them still. Okay. When we set up our structures, we use a third party. So a lot of times I'm my client's third party settler. That means I'm using my social security number to apply for the EIN number and create the structures on their behalf for their beneficiaries. So if that entity ever got sued, that structure, nobody can see inside the structure, not even a judge, because of the way it's written.
Wow.
And that. So, and what makes this trust structure unique is it is the only one that holds the assets that come into it in an escrow. It's considered to be held in escrow. It's the only structure like this that has that, and that's what's the proprietary and copyrighted. There's a lot of people out there
escrow from my days in the mortgage industry. Escrow just means it's yours. You just can't get it just yet.
Yeah. Right. And so own nothing. So get things out of your name, and we sell your assets, your home, your cars, your brokerage accounts, move your brokerage accounts. We change ownership and we sell the asset. Okay. But here's the thing with business owners. This is what I want to kind of end with. When business owners, let's just say that we've already talked about if they were ever sued and the structure owns their business, they're not getting anything. Okay. Mm-hmm. But the other side of it, when this business owner goes to sell that business for hundreds of millions of dollars, there's certain things inside this structure, the way it's designed and using the tax code, that is not considered income. Capital gains, that could be on brokerage accounts. People who are investing in properties, when they go to sell those, there's no capital gains. Don't have to deal with 1031 exchanges. But here's the thing, business owners, $100 million business, they're going to pay a minimum of $20 million in capital gains. If that's owned by this trust, those indefinitely until you actually pull money out of this environment, which we show people never to do, right? We want to work inside this environment. And that. So capital gains, K1 distributions is not considered income, interest, dividends, royalties. Oh, and rental income. So those property owners, this will allow you not to have to pay taxes on rental income, because this trust cannot be forced to pay taxes because of the way it's set up. It defers taxes in perpetuity. Okay. Indefinitely, infinity, until you actually pull monies out, which you don't, because the trust can buy any assets. It can invest in any business opportunities.
Wow. You know, so many of these points we've talked about here obviously are such that you can't just go Google setup and, hey, AI, do this for me. You know, never, ever could you do that. You need to have that team. You need to have that trusted guide like yourself. So if someone is interested in having maybe a second look at their structure, what's the best way they can learn more and reach out and connect with you, Michael?
They just need to go to safemoney123.com. Safe meaning you can't lose, right? That's what we're trying to do, right? We want to be the winners, so you can't lose. Safemoney123.com. That's the easiest way. You can book an appointment on there. Has my contact information and all that.
Excellent. Well, thank you so much for coming back on. This has been real enlightening for us.
Yeah, I loved it. Thanks.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneurssradio.com.